Hi everyone, welcome once again with another new concept. Friends, today we are going to discuss the concept of cost of capital. Friends, whenever we discuss financial management or we talk about any investing or financing decision as well as dividend decision, the most important thing that one has to understand is the concept of cost of capital. I'll start from the very basic. You see, whenever a firm is raising fund, so we call it capital. Whenever you are raising capital, there are different sources from which a firm can raise capital, right? We can have broadly the two distinct sources. One is the equity source, other is the debt source. The idea is very simple. Equity means owner's fund, that is the company raises by issue of shares, ordinary shares or equity shares, whereas debenture is a borrowed fund, right? So friends, so you can understand, one is a owner's fund, other is a borrowed fund. So there are some peculiarities associated with each of these sources of funds. However, we must have to understand that the equity shareholders get dividend and the borrowed funds we have to pay interest. So a company has to make payments in the form of interest to the borrowed fund, whereas it has to pay dividends to the equity shareholders. But one point we all know, that is interest is obligatory, means a firm has to pay the interest obligation as and when it falls due. But the firm doesn't have that much pressure to pay dividend if it is in crisis. In other words, if there is less profit, then dividend may not be paid. However, you cannot escape your interest obligation because it must have to be paid. Right friends? So that means equity shareholders are taking a lot of risk, because if the profit is inadequate, they are likely to not receive the dividend. So that means they are taking more risk, whereas this debenture holders, they are risk free, because whatever may be the conditions in the company, the investors here in this case are certain to get their returns in the form of interest. Now, having said that, it is quite obvious that since equity shareholders are taking a lot of risk, so they will demand a higher returns. So if it is 12% returns expected by the equity shareholders, so it will be less than this for the debenture holders. So friends, why it is so? Because they are taking more risk. And why it is so? Because they are taking less risk. That's why the return is lower. Okay, so this foundation is essential to know the concept of cost of capital. Now friends, whenever we are raising funds, suppose people are giving in the form of shares, or maybe the investors are giving in the form of debentures, they have some expectations from the company, right? If I say that 12% is the return that I am giving to the equity shareholders and 8% to the debenture holders, that's fine, because this is their specific rate of returns that they are getting from the organization or from the company. Now friends, as a manager, I have to ensure that whenever I am taking money and investing, see, I am pulling the money from the different sources and I am investing in different activities, right? So I must have to keep this point in mind, that wherever I am investing the activities, I must pay them wherever I am investing their fund, okay, because I don't have fund as such. Where did I get the funds from? I assembled it from two distinct sources. I will now invest it in some avenues. So whenever I invest in some avenues, I must have to keep in mind that the returns I get from those avenues must be greater than this, or should be at least equal to this. Right friends? Because see, if equity shareholders are expecting 12% from the money they have invested in my company, and I use their money to invest in some avenues, I must have to ensure that that generates a return of at least 12%, and better to generate more than 12%. Right friends? So now friends, this is because whenever the investors are putting money in your company, it is having an opportunity cost. If you don't pay me 12%, I have the opportunity to take off my money and invest it somewhere else, right? So you must have to pay me whatever I am getting outside. You must have to pay me minimum this much, and over and above whatever you pay, that will be a great matter. It will be maximizing my value as such. Okay friends, so now having given this foundation, let's move on to the concept of cost of capital. So friends, as you know that company is borrowing from different sources, raising fund from different sources. So generally we have the cost of, see, this is called equity. So I have equity capital, I have debentures, and I have preference share capital. There is a little difference. I mean, there are some differences between preference share capital and equity shareholders. Equity share capital means they are the owners and they are the residual owners, in the sense, I mean, they have the residual right. In other sense, whatever is the profit after paying the debenture holders, whatever is left, the equity shareholders will get. But preference shareholders will get priority over equity shareholders, means before any dividend is given to the equity shareholders, preference shareholders has the right to receive the first. Okay, before equity, the preference dividends will be paid. So they get dividend, they get interest, and they also get dividend. Okay friends, so now when I find out the cost of capital of equity, when I find out the cost of capital that is raised from equity, we called it KE, whereas the cost of capital that is raised through debentures, we call it KD, and the cost of preference shares, we call it KP. Okay friends, so friends, when I have to find out the overall cost of capital, okay, I have to find out KO. KO means overall cost of capital. Okay, so what is overall cost of capital? It is the total cost that is coming out of the total capital that the fund has raised. So we are going to find out the overall cost of capital. Friends, what is overall cost of capital we will see later, but we have to first identify how to calculate the cost of debt, cost of equity, and cost of preference share capital. So in this video we will first talk about the cost of debt, okay, and cost of preference capital. These two we will cover in this video, and in the next lecture we will talk about the cost of equity and the overall cost of capital. So let's begin first by learning how to calculate the cost of preference and cost of debentures. So friends, one more thing I would tell you, that debentures means borrowings, and even bonds can also be a kind of borrowing. So bonds is actually issued by government authorities, whereas debentures are issued by companies or corporate bodies. So this is the only difference. However, computational wise they are the same. They are same. So what we will do, we will calculate cost of D means debt. It could be debentures or bonds, and cost of preference capital. So let's begin. So friends, we will take up the first case now, the cost of debenture. Cost of debenture. Okay, it could be cost of bond also, cost of bond or debenture. As I have told you, since it is a borrowed fund, so we will represent it by KD. Okay, now friends, we will try to know the feature again, that debenture holders, they get interest, I told you, and this interest is quite certain. The company will invariably make the payment of interest, so it carries a less risk, right, because the default risk is low. Now friends, we will see how to calculate this KD. How to calculate this KD is, if we will have two cases here. Case A, that suppose that it is perpetual in nature. If the debenture is perpetual in nature, that means you have borrowed this money and you are never going to refund it. You have taken some loan, debenture. Debenture can be perpetual, means it goes on. This money will be staying in the organization for lifelong. So this is called perpetual debentures. If it is a perpetual debenture, then remember friends, KD is nothing but, remember, all the debenture gets interest. So you will write here interest, and you have to divide it by SV. SV means sales proceeds of debentures or bonds, means when you have issued debentures or bonds, how much money you got. So interest payments divided by SB. So I will write in simple form, I divided by SB is the cost of debt. Okay, cost of borrowed capital or cost of debenture. Agree? Now friends, this is about perpetual debentures. So perpetual debenture comes as I divided by SB, whereas I is the interest payments, NSV is the sales proceeds value of out of the issue of debentures or bonds. Now one thing you have to understand, what is that? Friends, here is something bit technical that you must have to understand when you are calculating the cost of borrowed fund or cost of debt. That is, when you are every company has to pay tax, as you know, okay, and tax is paid on the operating profit, earning before interest and tax. What is EBIT? Earnings before interest and tax, right? Now see, if it is EBIT, means whatever the company has earned before deducting interest and before deducting taxes, suppose it is this much, okay. From this the company will first minus interest, because I stands for interest, okay, and then whatever remains from this the company will then minus the taxes, okay. Then whatever comes is the earnings after taxes. Remember friends, again I am telling earnings before interest tax. Whatever is the company's earning before it has paid interest, before it has paid tax. Now once you know this much, then you are going to deduct the interest and then you have to deduct the taxes. One thing you should observe here, that the friends, when you have income, you deduct the interest. If you deduct the interest, this money is lower because this is higher than this, because you have deducted interest, so this value is lower than this value. Since it is lower, so you are paying less tax. If you don't deduct this, you will pay more tax. Are you getting my point? So you will deduct tax on the net amount after deducting interest. If you don't deduct interest, then your tax amount will be more because you will be paying on this amount. Okay, if it is clear, then I proceed further that since you have borrowings, means borrowed capital, you are paying tax. And because you are paying tax, since you have a borrowed capital, you are paying interest. And since you are paying interest, you are getting some tax benefit because your tax value will lower. If there is no interest, you have to pay more tax, right? So when you are saying that you are paying interest, that's fine, but along with interest, you are saving some tax also. Right? You are paying interest 60 rupees, but you are saving 20 rupees tax. Okay? So I have to minus this by 1 minus T. T stands for tax rate. T stands for tax rate. Why? Because that will tell you what is your net interest that you are paying. Okay? I into 1 minus T, that is the tax shield or the tax advantage on issue of interest. So each time you have the tax into your picture, you have to multiply this 1 minus T, this is the tax rate, and then you divide by the SV, that is the sales proceed by issue of debentures or bonds. Right friends? So this is the case of the finding the cost of debt when you have a perpetual debt in your business, means it is not going to be repaid any time in the lifetime of the company. Let's take up a problem and see how to solve this. So friends, this is a question in front of you that the company has issued 15% perpetual debt amounting to rupees 1 lakh. Okay, and tax rate is 35%. Find KD, means you have to find out the cost of debt if it is issued at par, if it is issued at a discount of 10%, if it is issued at a premium of 10%. Okay, you know that sometimes what is this discount, premium and par? Suppose you have issued 100 face value means the original value of a debenture. Suppose the face value is 100 and you are issuing at a discount, means say 10% discount, means you are issuing at 90, and maybe it is while you are repaying them back, you will give them 100 only. So this is called issued at a discount. It could be issued at a premium, its face value is 100, you may issue it at 110. Right? This is called premium and this is called discount. But if you issue exactly at the face value, we call it at par. Now let's understand what is the cost of debt if it is issued at par. So just now it is already mentioned, it is perpetual. So you know KD is equals to I divided by what is that, SV, and then 1 minus T. Okay. So you know case A. Case A is issued at par. So what is interest? Interest 15% of 1 lakh. 15% of 1 lakh will be how much? It will be 15, 0, 0 and 0 divided by what is the SV, means how much money you got by issuing the debentures. You got 1 lakh and it is issued at par, that means you got 1 lakh only, there is no discount. Okay, and what is the tax rate? 1 minus 35%, so 0.35. Okay friends, so you get here what is the value of KD when it is issued at par. Okay, issued at par, so KD is equals to this much. Coming to second case, when it is issued at discount. Discount is how much? 10%. So interest is 15,000 only, and when it is issued at a discount of 10% means you are getting 10,000 less, so it is 90. So you get 1 lakh minus 10,000, so it is 90,000 into 1 minus 0.35. The other one is issued at a premium. Premium KD is equals to 15,000 divided by 10% is the premium, so it is 1 lakh 10,000. So 1 minus 0.35, this is the after tax cost of debt. This part shows that after paying tax what is the ultimate cost of the debt. Let's calculate and see how much is the value coming here. So friends, after calculation we see that you got here 9.75% is the KD, 10.85% is the KD, and 8.84% is the KD. Okay friends, now let's see the next case when there is no perpetual debts. When the debt is not perpetual means you will not repay, but we will go to some other case when it is to be repaid. We call it redeemable. If the debt is redeemable, if it has to be repaid, how you will do the calculations. Now we take up the second case, that is redeemable debentures or bonds. So here the bonds or debentures are to be repaid after some number of years. Now friends, you have to understand this very carefully. Now friends, do you understand that when you are issuing here suppose you have issued on this date, means you have raised money on this date, and this is the day when you have to repay them. So there is a cash inflow here, means cash is coming to you, and there is cash outflow there, right friends? Now what you are doing is that whenever you are outflow means what? Outflow means you are repaying the principal here. Whatever money you have gathered, you see, whenever you are raising money, you are getting two things, principal plus interest. So principal has to be repaid at the end of the year, whereas every year, where whatever number of years you have kept the debenture, you have to pay the interest. You have to pay the interest. Okay friends? Now what is cost of debt then? You have to understand two things here. First thing is that every year you are paying interest, and end of the year you are paying the principal. Okay, this is what you are doing when you have borrowed money. Every time, every regular interval you are paying interest, and end of the tenure you are paying back the principal. That's fine. Now friends, what is cost of debt then? Cost of debt is KD is equals to, we will not know what is KD. We have to find out what is KD. That is what we are doing. In the case A also we try to find out what is KD. We have to see that our cash inflow is this side. Okay. And this cash inflow is taking place at year 0. Means just this year, year 0, you have got some money by issuing debentures. Is equal to, it should equate with all the interest payments that you are making. So suppose you are making interest outflow, this will be cash outflow, CO, cash outflow in period 1, cash outflow in the form of what? Cash outflow in the form of interest. So I can write cash outflow in the form of interest for the first year divided by, now please try to understand, 1 plus KD to the power 1. What does this mean? This means that you are paying interest in the year 1. This is year 0, this is Y0, and this is year 1, you are paying interest. So your cash outflow is interest. And what is this part? This part is discounting factor. You are trying to discount this value to know its value on 0 date. This is what we have studied in the time value of money. In time value of money, we have seen that whatever money comes to you in future dates, you have to discount it so as to know its current worth today, right? So CEO means cash outflow of interest in the first year divided by 1 plus KD to the power first. We don't know what is KD, I am just writing, plus cash outflow of interest in the second year divided by 1 plus kd to the power 2. This way you will do for all the years until the last year's cash outflow in year number tth year, last year, t is the last year, divided by 1 plus kd to the power t. Done? You have come to the last year's outflow. But friends, in the last year you also have to repay the principal. So there is a cash outflow COP. Now it is not interest, it is principal. On which date? On the nth period, the last period, divided by 1 plus kd to the power n. Okay, so you are doing what? You are trying to find out the sum of this value should be equal to this value. Friends, we know what is our outflow, we know what is our principal, we know what is our cash inflow in this year, but we don't know what is KD. Right? We don't know what is KD. So I can write it here, summarizing it. CIO, cash inflow in period 1, period 0 is equals to sum of all these first, not principal, all these first. So I can write sum of I is equals to 1 to T COIT divided by 1 plus KD to the power T. This is this part plus the, what is this? This is cash outflow of principal in period N divided by 1 plus KD to the power N. So this equation is simplified to this form. Okay. Now question is, we have not got our answer, what is KD? We don't know what is KD. How to find out KD if things are like this? Now if you have to find KD, then you have to see what is happening. What is happening here? You have the inflow known to you. You know the outflow, how much will be per month, per year, what is the installment. You also know what is the principal to be repaid at the end. But one thing that you have to keep in mind, these all payments are to be discounted by this factor. So as you have seen in my last video or the last lecture on time value of money, this 1 plus KD is the discounting factor. Okay. Now if I have to know what is 1 plus, if I have to explain you again, if you remember, I have told you present value is equals to present value factor. Present value factor is equals to 1 by 1 plus r to the power n. This is your present value factor, right? Now friends, you have to find out that this is your present value factor. You have to know for what discount rate, okay, for what discount rate is your present value for the first year equal to this much. For what discount rate? Discount rate is this one, okay. This is the discounting, present value factor means the discounting factor. For what discounting factor? For 1 rupee for 2 years is the present value is this much. Sorry, the discount, not discounting, what interest rate? What rate of interest will make the present value of 1 rupee equal to this much? Okay, so what we can do here is that we can simplify this matter. Till here, if you have understood, don't worry about the complexities of calculating KD. If you have understood this much, then we can take up a sum and then see if this is the situation that we know the outflows, we know the inflows, but we don't know how to KD, how to find it. We will see it now. But mathematically, this is the equation. We will go and take up a sum and find out how to do it. But before that, I want to tell you, sometimes it may so happen, you know, this principal, instead of repaying at the end, we pay it with the interest itself. So if principal is also paid in installments along with interest, then what is happening? This formula will be CIO is equals to sum of I is equals to 1 to T. Sum of two things. Every year you are paying interest plus every year you are paying the principal divided by 1 plus KD to the power T. So there is this component will not come, because with this we are adding every year. Every year we are paying principal. Every year we are paying principal. Okay friends, now this is the formulation. Now let's take up a sum and then see how to calculate KD. Don't worry, by seeing that this KD how we will find out. I'll make it easy with the help of a problem. Let's begin. So friends, I have a question before you, that is 15% debentures of 1000 face value. This is the 1000 face value. Okay, this is face value FB, issued at 5% discount. So this is the face value issued at 5% discount, redeemable after 10 years. So it's not a perpetual debenture, it is a redeemable debenture after 10 years. It involves flotation cost of 2.5% of face value. Means when you issued the debenture, you have to pay the flotation charge of 2.5%. Okay, and there is a tax of 35%. Calculate KD. So you have to calculate KD. Okay, friends. The formula, the notations that I have shown, you keep this in mind, and let's begin how to solve this sum. Okay. So friends, you can see here that the debenture is issued at the face value is 1000, but it is issued at a discount of 5%. 5% of this will be how much? Okay, 5% of this will be 50, so it is 950. But when you are issuing, there is some flotation cost of 2.5%. So minus 2.5% of 1000, because it is the 2.5% of the face value. Face value is 1000, so it will be 25. So ultimately, what is the value? This is 725. Oh, sorry, not 725. It will be, sorry, it will be 925. Okay, so it is 925, right? So your cash inflow at period 0, Y0, the cash inflow is 925. But cash outflow of principal, how much you will repay? 1000. Okay, so you are going to pay it after 10 years 1000. You are going to pay after 10 years 1000, but annually you are going to pay the interest. What is your interest? Your interest is 15%. So 15% of 1000, this is 1000, so 15% of 1000 is 150. This way you have to pay every year and till the last year. So friends, what we are doing, if you follow the notation, don't worry about the notation, what we have seen just now, cash outflow at period 0 is equals to sum of all the, cash inflow. Cash inflow at period 0 is equals to sum of all the what? Cash outflows from period 1 to period 10, because we have 10 years of what? Cash inflows of interest. Okay, cash inflow of interest divided by 1 plus KD to the power 10. For 10 years, you are making cash inflow of interest. Okay, from first year to 10th year, 1 plus KD to the power 10. Plus, in the last year, you are making the payment of principal divided by 1 plus KD to the power 10. The 10th year. Okay, you better write 1 plus KD to the power T. Here T is 1 to 10. Okay, so friends, what we are doing here, we are trying to find out if COI, that means cash inflow of input, is 925, is equals to sum of I is equals to 1 to 10. What you are going to sum? All the interest. So friends, you are paying interest 150. But friends, don't forget, whenever there is a tax, you have to write 1 minus T. Okay, interest into 1 minus T. So 1 minus T is interest. So, tax. So what is tax? Tax is 0.35. So if you find out 150 minus 0.35, then you will get what is your actually tax adjusted interest. What is your tax adjusted interest? So let's find out 35% of 150. So it is 52.5 and it is 90. Let's see again. Let me see the calculator. It is coming 97.5. So it is 97.5. Okay. So every year you are actually paying the net interest of 97.5. So I am writing here 97.5, and it has to be discounted with 1 plus KD to the power T, plus end of the year end of the tenure you have to make the payment of principal 1 plus KD to the power 10. Okay friends, so now we have got this. But what we want to know this KD. My objective is to get the KD. So for KD, there are two methods to find. Under these circumstances, there are two methods. One is a long method. We call it trial and error method. The other one is a shortcut method. Let's first do the long method, that is trial and error method. Trial and error method. So under trial and error method, what we will do, we have to find out that every year from 1 to 10, you are paying interest how much? 97.5. So 97.5 you are paying for year 1 to 10. Just note here, from year 1 to 10 year, you are paying 97.5. Okay? You have to find out what factor I have to discount this, right? So for knowing the factor, you have to try with some rate of interest, because whenever you find out the present value factor, you need two things. One is the number of years, and you want to know the interest. Okay, you have to know the interest value and the number of years. So number of years is known to us 10 years. Okay, so we will see in the present value of factor of annuity. Why it is present value factor of annuity? As I told you, when the amount of cash outflow is same, then we have to refer to the first thing is that we have to refer to the annuity table. And in annuity table, we search for two things. We search for number of years, and against the rate of interest, we find what is the value of 1 rupee. We find out what is the value of 1 rupee. Remember, in present value annuity table, you have to find out for 1 rupee, for some number of years, and at the rate of interest, what is its present value. We try to find out its present value. Okay, so we definitely have to find out the present value, and this present value will be known only when we know the number of years and the rate of interest. But in our case, number of years is mentioned, that is 10 years. But the rate of interest or this KD is not known to us. So what we will do is that we will try to find out with some arbitrary, we will try with trial and error method. We will try to find out present value of annuity at the rate of 10%. We will start with 10%. Okay. Now, if you see the present value of annuity at the rate of 10%, we get a value. I will show you the value right now. So friends, try to understand. I have already calculated to save time that from first year to 10th year, I am paying 97.55. Since the amount of installment is same, I will refer to the annuity table. But for referring to annuity table, I need two things. One is year and the rate of interest. But I don't know what is the rate of interest, but of course I know years. So I will, from my mind, I will use any rate, say 10%, because it is trial and error method. So I started with 10%. So I searched in the present value of annuity table that at 10%, what is the annuity factor? Okay, for 10 years, because 10% is my assumption. 10 years is given in the question. I find out how much it is. It is 6.145. I can show you very shortly. I will show you in the table. Now this into this will come to 599.14. Okay, so that means present value is 599.14. Okay, now question is, I don't want 599.14. I just have calculated for the installment. Okay, now for interest, principal, this part you ignore for time being. Just find out for principal. 10th year you are paying how much? 1000. Okay, so you are paying 1000 in the 10th year. This is 1 to 10 year, but this is in the 10th year because principal is repaid in the last year. So it is 1000. You have to find out the present value of not annuity but just present value factor, not annuity, because this is not a regular payment, it is just one payment. Okay, so I will try to find out at 10% how much is this. It is not annuity, it is a regular present value factor of 10% for 10 years. So if you refer to the book, you will get the factor. So friends, what I have done, 1000 and the factor is 0.386. So when I multiply, I get 386. So don't refer to this part for time being, just refer to this part, the first part. For 97.5 annuity factor is this, I got this much. For 1000, the present value factor is this, I got this much. What is the total coming to? I will check. If you total, you will see the total is 985.14. That means if I have KD, suppose I assume the KD is 10%, my assumption, then I will find that for installments I get 599.14 and for the principal I get 386. If I total, I get 985.14. Okay, but if you remember, this side total should be equal to this side, so I got this side total is 985.14. but what is my cash inflow at year 0? It is 925. So it is not equal. That means these two are not equal. These two are not equal means you have to reduce this amount. This side is 925, this side is 985. If you have to reduce this amount, you have to discount it at a higher rate. That is, my assumption of 10% is not perfect. I have to discount with a higher rate. So I selected 11%. So the same thing I am multiplying with the present value of annuity and I get here and write here. Same thing I multiply with 11%, I write here. If you total, you get 926.18, which is somehow equal to 925. So roughly equal to 925. Okay. So that means I can say that the cost of debt is KD is equals to 11%. Okay. It comes to 11%. So friends, I hope it is clear that how you are calculating the cost of a debt when this debt is issued at a time and redeemable after a period of time. So I got that the cost of debt will comprise of two components, the present value of all the interest plus present value of the principal at the end. The present value of all the interest, it has to be discounted with some rate, and that rate is the cost of debt. Now these rate have to be identified. For this I do some trial and error method, and with 10% I try how much it is coming, and then I see that it is quite high, so I have to discount with a higher rate relatively. So at 11% I do, somehow whichever is close I consider it to be the right rate. So I find the KD is 11%. So friends, this is a trial and error method, but there is a shortcut method too. Let's understand what's the shortcut method. So friends, this is the formula, shortcut method. Try to understand the formula. This is I into 1 minus T plus F plus D plus PR plus minus PI by N divided by RV plus SV by 2. What are all these? Now remember, T is the tax, you already know. I is the interest on debentures, you already know. F is the flotation charges, flotation cost. Okay, flotation cost. D is the discount on issue. Discount on issue. PR is premium on issue. Premium on, not issue. PR means premium on redemption. When you are redeeming, suppose you are redeeming this 1000 rupees here 1000, but in redemption if you are making it 1100 or 1500, then the premium on redemption will be plus. But PI means premium on issue. At the time of issue, if there is a premium, in our case there is a discount, but if there is a premium, then you have to minus, divided by N. N is the tenure, for how many years you have taken. RV means redemption value. At the time of redemption, how much you are paying, and SV means sales value, means when you have issued the debenture, how much was its value. Let's try and see. KD is equals to I how much is the interest? Interest is 97.5. Sorry, this part. I into 1 minus T. Okay, let me write 150 into 1 minus 0.35 plus. What is our flotation cost? Flotation cost is how much? 25, no? This one. Flotation cost 25 plus. What is our discount? 50 rupees. Is there any premium on redemption? No. Is there any premium on issue? No. These two things should be divided by 10. That is how much is the debt tenure. Whole thing divided by redemption value is 1000. And what is the sales value? Redemption value is 1000. The sales value is 925. And these two should be divided by 2. If you simplify, you will get 11%. So this is a shortcut method, provided you understand it. If you make a little mistake here, the answer will be wrong. Better you go for a trial and error method in that case. Okay. So let's see it again. So friends, that's all how we can calculate the cost of debt. And friends, we are left with the cost of preference capital and equity capital. We will see it in the next video. Thank you for watching. Goodbye.